Hi, and welcome to our How to Save Tax webcast. Saving tax is one of these things that's been in the news quite a lot recently, with all sorts of high-profile cases. Jimmy Carr, Google, Starbucks spring to mind almost immediately. But are there still legitimate ways to actually reduce your tax bill? I'm Ian Forsyth, and with me today I have Paul Capewell and Ernest Smart of the A9 Accountancy. And we're going to be spending the next 45 minutes talking to Paul and Ernest about some of the new legislation that's been introduced, but also looking at ways where it's still reasonable to reduce your tax bill, because at the end of the day, none of us actually want to be spending more on tax than we have to. Yes, pay what you need to, but not any more than that. But before we go any further, I think it's probably worth just having a quick word with you, Paul, in terms of A9 Accountancy. You've kind of changed your name and your branding recently, but can you tell us a little bit more about the company? What is it that you actually do?
Yes, Ian, thank you. A9 Accountancy are an independent firm of chartered accountants trading out of our offices at Cradle Hall Business Park in Inverness. The office is headed up by Ernest Smart next to me and myself, and we're supported by a team of 10 professional staff. We provide the usual range of accountancy services, tax services and audit services. Our particular specialisms come from our time spent in larger firms in years gone by, and our specialisms are tax and tax planning and business consultancy. And our ethos is quite straightforward in that what we want to do and try to do is help our clients to achieve what they want to achieve.
So a lot of what you do, I assume, must be around trying to make sure that people aren't paying tax unnecessarily. Is that a big part of your work?
That's it, absolutely.
Yeah. Okay, well, hopefully over the next 45 minutes we can explore that in a little bit more detail. But before we do, just for those of you who are familiar with our webcasts, you'll know already, so bear with me. But for those of you who are new, these are interactive, so you do have the opportunity to submit questions via the chat box on the right-hand side of this video window. All you have to do is type your question into the little box and hit enter, and those will come through to us here, and we'll try to work through as many of your questions as we can with both Ernest and Paul. One thing I should say, probably we were talking about something in relation to tax, and I'm sure they'll both reiterate that. Sometimes answers, if it's a very specific personal question, might be quite difficult to give you a specific answer. It may have to be in general terms, but we will put up both Ernest and Paul's contact details at the end, and if you want to contact them direct, you'll have the opportunity to do that. But moving back to you two guys, in the promotional material, there was an interesting quote from Lord Clyde, which essentially seemed to say no one should be under any obligation to make it easy for the revenue. Surely with all the stuff that's gone on and the current state of the economy, surely that's a kind of outdated viewpoint.
I think, Ian, yes, in many ways we're talking about a case here that was heard in 1929 when we're referring to Clyde, and it was very much a case of its time. And what Clyde very clearly set out was that so long as the taxpayer and their advisor had the ingenuity to do so and the resources to do so, that they could use the tax system to come up with any contrived situation that they could in order to minimise the tax bill. I think it's quite important now to understand that actually we've already moved in a significantly different direction to those early rulings in Clyde. So we need to understand two specifically significant cases through history, and from 1929 we need to wind the clock forwards right to 1982 to a case called Ramsey versus Inland Revenue Commissioners, and another case that was heard at a similar time being Burma Oil Co. Versus Inland Revenue Commissioners. And what we had in this case was a situation where these companies had made significant capital gains. And in order to avoid the tax on those significant capital gains, a set of self-cancelling transactions were put into place. that resulted in zero tax when ordinarily there would be significant tax. And the ruling in Ramsey was significantly different to the ruling in Clyde, in that what it said was that because we have this sequence of self-cancelling transactions, that the correct treatment was to tax them as if those transactions weren't there. So you see through it. Mm-hmm. And it was a real landmark case in that what it did was it was to pull away from the 1929 ruling that basically you could do what you wanted. Here it's more of, well, you need to do things that are in accordance with what Parliament intended when the legislation was produced. So yes, things that would seem unacceptable in Clyde have been challenged in Ramsey and successfully challenged. And then we've got a further case in 1984, the Furnace case, which again, there was a further tax scheme, if you like, put in place specifically to avoid tax. And again, in that case, things were strengthened in further of the revenue, and that it wasn't quite simply that we had a sham, as we had in Ramsey. What we had was bona fide transactions, but the purpose of the transactions was purely to avoid the tax.
Right. And
again, on appeal, the courts found that that was not acceptable. And then we have to pedal forwards to 2013 and July 2013, and the general anti-abuse rule, which again we'll talk about in more detail, but that's a further tightening. So to answer the question, yes, it is outdated. We moved away since that with the cases that we've talked about, and GAAR is the next progression to catch more of what I suppose people or generally the public might consider to be unacceptable tax avoidance.
Mm-hmm. I think that general anti-abuse rule, or GAAR, as you mentioned, is very recent. Probably a bit of a response to some of the stuff that's been in the media. It's become quite high profile, the whole kind of big business and avoiding paying tax. You showed me something before we came down to go live, Ernest, which was kind of the explanation of a very small set of rules. I'm not sure if it was specifically in relation to GAAR. I suppose the challenge here, though, is if we take this general anti-abuse rule, that's correct, isn't it? Can you summarise that for us? Can you get that down to a level where people can absorb it?
Well, I'll try. But yes, I mean the rule came in July this year. It's the crux of the piece of legislation is a fairly short section 209 FA 2013, and the guidance that I showed you, yes, it's approaching 200 pages of guidance, essentially in relation to half a dozen lines of legislation. But what that piece of legislation does is to basically say that if there are tax arrangements which are in place which are abusive, then they don't work. And what is abusive is considered to be something where it cannot reasonably be considered that the particular course of action was a reasonable course of action in relation to the relevant tax provisions. So it's applying a double reasonableness test to determine what is or is not abusive.
Okay. Would it be safe to assume then, if we've got a double reasonable test and people have got to make a judgment on that there'll be a fair number of cases that will come before the courts on the basis of that?
Not necessarily.
Right.
I think the legislation, it's stated to be written as a deterrent, and I think it will be a significant deterrent to the sorts of cases that, the sorts of arrangements that most reasonable tax advisors, perhaps us, would have regarded as abusive and would not have gone anywhere near in the first place. So it will have a deterrent effect. Mm-hmm. Taking that a stage further, if someone does go into an arrangement and of course they consider that perhaps it is abusive, then there is an obligation for them to report that and make adjustments on their own tax return. I can't see why anyone would be doing that, because presumably they wouldn't have entered into it if they hadn't thought it to be abusive in the first place, which I think gets us back to your point, which is, are the revenue going to have a large number of cases? Well, the procedure for the revenue to take a case is that they must refer it to essentially an internal committee of experts in the area. Mm-hmm. If the revenue committee considers that it is the arrangements that they're looking at are caught by the GAAR, then that has to be referred to an external panel. The external panel does not have revenue people on it. It has external tax experts on it, who are then required to consider and provide an opinion as to whether the arrangements as they understand them are indeed something that could not reasonably be considered to be a reasonable course of action in relation to the relevant tax provisions. Right. And only if the revenue get an opinion from this external panel that it's not reasonable, that it fails the double reasonableness test, can they then take a case.
Right, okay, so there's some safeguards to stop
there
that.
Are plenty of safeguards.
Right.
I think it's really the deterrent effect of it simply being on the statute books that will have the greatest impact.
So at an everyday level, in terms of tax planning now, what's a reasonable approach in light of GAAR's introduction? What do people have to think about and do differently?
I think the thing to focus on, Ian, is that we still have significant choices, or taxpayers have significant choices as to how they can arrange their affairs. Mm-hmm. It's specifically stated within the GAAR legislation that, for example, just to put an example around it, that individuals may choose to be sole traders or partnerships or limited companies, and they may choose a mix of dividend and salary that's appropriate to them. All of those give significantly different outcomes for tax purposes, but those choices aren't going to be attacked. The choices are still there. So what we're looking for is a commercial reason for the choice, mm-hmm. or a legal reason for the choice. So with a limited company structure, it might have nothing to do with the tax. You quite simply need the limited liability protection. There's also other things that have always been available, so things that are written into statute where taxpayers are positively encouraged to take a course of action that might reduce their tax bill. So, for example, research and development super deductions. The point there is that the government want people to take advantage of these tax benefits in order to try and stimulate the economy. So there's a whole host of things that can still be done and still be achieved. Mm-hmm. And it's about making the right choices at the right time, which I think most of the public will understand, rather than enter into schemes that I think it's fair to say most of us would consider to be slightly or absolutely obscene and not defendable.
Mm-hmm, right. So looking back then to things that people might have done in the past, with the new legislation, what would be unacceptable now? What's the other side of the coin?
I think the most obvious examples of the unacceptable, at least from my perspective, would be some of the sorts of specific tax avoidance schemes that the rich and famous have entered into. And I'm thinking here particularly of icebreaker schemes, which were music partnerships and some of the film partnership schemes, the Eclipse 35 partnership, where if you strip away the fig leaf of respectability being some sort of commercial investment, essentially what was happening was people were putting a small amount of money in, they were making a gain on a liability which is not taxable, and they were making a loss on an asset which was tax deductible. So by paying a small amount of money away, they were gaining a very large indeed tax deduction. Right. So those sorts of things where the economic result bears no relationship to the tax result, mm-hmm. those are clearly going to be unacceptable.
Right. So are we safe in assuming then that these high profile cases, you mentioned the rich and famous and the big companies, are we safe to assume now that we won't see the Jimmy Carrs, the Googles and the Starbucks in future?
The three you mentioned, I certainly wouldn't think that Starbucks and Google are anywhere near the general anti-abuse rules. They have simply taken advantage of the international norms as to where should particular function, risks, activities be taxed, and they have chosen, because they are global companies, they have chosen to locate the valuable, from a tax perspective, parts of their global organisation in low tax regimes. So GAAR goes nowhere near that. I mean, that's a problem of largely of our own government's making.
Right.
It was largely responsible for writing the OECD guidance, the OECD rules. It was a leading light in doing so, and the rules have simply not moved on.
Right.
They need to go and rewrite the guidance in relation to transfer pricing to do that. So certainly Starbucks and Google, nowhere near it. Jimmy Carr is probably nearer it, but the scheme that he went into was essentially a thing whereby instead of receiving remuneration, he received a loan.
Mm-hmm.
Essentially that's a tax deferral scheme. That may fall within GAAR, but it's not as obviously within GAAR as some of the other things that I was talking about earlier, the Eclipse and the icebreaker schemes.
Right. So we might still see some of them in the future.
Well, I think there's probably plenty of other avenues for the revenue to use to attack them based on non-GAAR legislation and case law.
Okay, we move on a little bit now and start to look at, planning. We've talked about what's acceptable, and we've got a question from Tom, so let's lead off with that, because I think it's a really good kind of summarising question here. What's your top tip when starting to review our tax bill that could save us money? So let's cut to the chase, the top tip.
Tom, I think the top tip that I'd give, I think it's a very helpful question in terms of doing things making the right choices at the right point in time. And I think the first point that I'd make is it's not necessarily all too late once you've had the first go at working out your tax bill. But my advice to people would always be, we want to be reviewing the position before you reach your accounting year end and the fiscal year end, because then you've got time to do such things as making pension contributions, making capital purchases, if that's going to be advantage from a business point of view, and also from a capital allowances perspective. Looking at bonuses for staff and timing, all of these things, it's better and much easier to get yourself to a tax position before history overtakes you, rather than going back to try and deal with things that have already happened.
Ideally, is there a kind of time scale you should allow yourself? Are we talking 6 months, 3 months? I mean, what would you advise?
Well, certainly it depends on the nature and the size of the business, but if we're talking about a sole trader, it's a month beforehand, because you've got fairly up-to-date figures, then you're just missing a month off the year end. That could be suitable. Again, it's an iterative process, so it's not something that you do once. Legislation changes, your own personal plans change, so it's something that needs doing year on year and adjusting in order to make sure that it's reaching your own aspirations. That might be aspirations for the business or income requirements, and of course those change. If you've got children, they grow up and your expenses profile changes. So it's, yes, before the year end, significantly before the year end if you're a larger organisation, but certainly an iterative process that gets visited at least once a year, and for larger organisations once a month, once a quarter.
Okay, so plan in advance seems to be the kind of summary of that one for you.
Absolutely.
I can't let you off the hook, Ernest. I know Tom asked for one top tip, and we've had one from Paul. What would yours be? Obviously, you'll agree with Paul on that one, but what would your other one be?
Yeah, come and talk to, whether it's us or another advisor, before it's too late. I mean, that has to be the fundamental. So if we've got the tax bill, it's too late already, in my view. But yeah, look at the basics, which is the sorts of things that Paul was mentioning. That's the first port of call. The sorts of things that there is government encouraged by government policy because it suits their policy objectives. So pensions, capital allowances, investment in certain types of venture that the government wishes to encourage.
Right, and of course we've got to bear in mind that all of this shifts on a regular basis as well. It's not a static set of rules.
That is unfortunately the case. We as tax advisors wish it wasn't, but for the past decade or so, I think the sort of smallest Finance Act has been about 400 pages of very small writing of legislation. It's quite difficult to ensure that you know what is happening for the following year. It's moving all the time. Right.
I was reading the briefing notes that you had sent through to me beforehand, and I came across I don't know if it's a phrase or just a couple of words, income shifting, and I was completely at a loss. What is income shifting, and what's the benefits of it? Can you do it?
Income shifting is basically where husband and wife or spouses move income from one of them to another. Before we had independent taxation, husband and wife were taxed as one, so it didn't matter if one spouse had significant income and the other didn't. They were taxed as a single unit. We've had independent taxation for a long time, so that each individual has their own personal allowance and they have their own income tax rates. So if one looked at a situation, perhaps a traditional situation where one of the spouses went out to work and the other didn't, stayed at home to look after the children, that stay-at-home spouse would not be using their personal allowance, would not be using their basic rate bands. On the other hand, the spouse that is working, if they're a higher rate taxpayer, they're paying quite heavy rates of tax. So it is income shifting is where one puts in place arrangements that move some of the income to someone that may not have previously been working in order to reduce the overall tax bill. Okay.
Actually, there's been a question from Kay that kind of ties in sort of loosely to that. So we bring Kay's question in, thanks for that. Will HMRC be looking at small privately owned limited companies where directors have the same set amounts each month for salary and director dividend? And she's going on to say, i.e., should the dividend amounts be varied each month? What's your take on that?
Well, yes, I mean, it's certainly an area. I think what we're talking about here is the mix of salary and dividend, and is there a risk of the revenue taking the view that dividends are actually salary and therefore earnings and therefore subject to pay as you earn and national insurance contributions. Of course, at the moment, dividends are not subject to national insurance contributions. And I think my view on that is you need to take a careful look at the situation and the reality of the position. I think a lot of people are aware that a classic bit of planning is that there will be a mix of dividend and salary put in place to optimise the tax position. The revenue have tried on numerous occasions to attack the payments of dividends on the grounds under the auspices of the settlements legislation. So the Arctic Systems case is the famous one in that respect. But that's actually quite difficult in the context of company law, a dividend is a dividend, whether you're a small limited company with 1 or 2 directors, or whether you're BP, a large multinational. What I would say is you should be very careful with your corporate governance in terms of documenting what the salaries are and what the dividends are. And of course, perhaps if you're paying monthly dividends, that might seem a little unusual. If you're filling in timesheets, that's unusual because you don't need timesheets for dividends. Again, you'd expect to see dividend documentation in place for each dividend that is paid. And of course, dividends can only be paid out of distributable profits. And in order to determine if you've got distributable profits, you need appropriate management information. So I'll try and cut the story down a little bit here. What I'm saying is that what I would expect to see is a dividend looking like a dividend, perhaps paid on a quarterly basis with reference to appropriate management information, and then it's quite hard to challenge.
Right.
I think just to add, I mean, there has been one fairly high-profile case recently, which essentially the Court of Appeal did decide that dividends could be subject to pay as you earn. But that was an unusual case in that the share arrangements were very contrived, that there were many different classes of shares and the dividends paid on each class of share varied significantly. So it was a clear, if you like, attempt to avoid tax and to divert what should have been salary into dividend. If one's looking at a straightforward case where this is the amount of salary and we'll pay some dividends on top, then provided you go down the route that Paul says, it's highly unlikely that the revenue will challenge.
Okay, so the basic message here then to Kay is essentially that it shouldn't really be monthly. Is that what you were saying?
Well,
or should it?
Conceptually, that shouldn't be a problem.
Right.
I mean, for me, it's a matter of managing the risk, and to me, most dividends are paid quarterly. They don't have to be.
Mm-hmm.
A dividend can be paid at any point in time, but it's a matter of sort of minimising the risk of challenge. And yes, I mean, my advice would be a dividend should look like a dividend, and perhaps it should be paid quarterly by reference to appropriate quarterly management information.
Right.
And so just to add to the points that Ernest were making there as well, just on the point of the share capital, if the share capital that you have, Kay, is ordinary share capital and all of the shares have equal rights, you really shouldn't have a problem.
Okay, well hopefully Kay that answered your question. If it didn't, please feel free to add in a little supplementary, and if we've got time we'll put that to Paul and Ernest. And just a reminder, we are getting close to being 2/3 of the way through here, so if you do have questions, please get them in soon, or we may run out of time and not be able to deal with them. So let's go to another audience question. Do I get tax relief for payments into my pension scheme? I think pensions were mentioned briefly earlier, but can we pick up on that one? Do you get tax relief on pension payments?
Yes, is the short answer. I mean, the mechanism of the relief, it depends on the type of payments. But so let's talk about a payment into a personal pension plan. And the way that the relief works for a basic rate taxpayer is that if you pay £80 into your plan, the government will put £20 into the plan. So you end up with £100 in the pot. Right. for an £80 contribution. For a higher rate taxpayer, the story's better in that for the same £80 contribution, you get the £20 into the pot, and then you get relief through your self-assessment tax return. If you're a 40% taxpayer, you get £20 off your tax bill. So for personal pension contributions, it's quite tax efficient.
Okay.
Again, for company pension contributions, so if your employer's making the pension contribution for you, it's the employer that gets the deduction against their profits, mm-hmm. rather than yourself that gets it personally. But either way, there's good reliefs to be had there.
Right, so it sounds like a sensible move for people to consider that. Mm-hmm. Sally just wanted to pick up again on the conversation we were having about income shifting, and she just wants to clarify. So it's just a quick overview. It is something that's allowed, and is it straightforward? Is what she's asking.
I suppose there's two questions in there. Is it something that's allowed? The Revenue have not come up with a satisfactory way of stopping it. They've had three goes. They litigated to the House of Lords, as it was then, the Arctic Systems case, and they lost. They then tried to bring in one set of legislation which tried to address the issue as they saw it. It was so fundamentally flawed that they had to withdraw it. They had a second attempt at bringing in different legislation to stop it. That again was basically thrown out of court as unworkable in practice, so it was never brought onto the statute books. Yes, I mean, how can one do it? We're talking about husband and wife here, or spouses, or civil partners. The basic proposition is that you involve the other spouse in whatever the business activity is. If that's a partnership, then the Revenue are on the record as saying they would not normally seek to challenge the division of partnership profits or losses between spouses, civil partners. Another way would be if business is run through a limited company, for the spouses to both have shares in the company from the outset. For a variety of technical reasons, we'd recommend there were founder shares as opposed to setting up a company and moving shares afterwards. But thereby, either through partnership or by limited company, setting up a way in which both spouses, civil partners, can be remunerated either as a profit share or as salary and dividends. Okay.
We've got a follow-up question from Kay, but I'll come back to that just in a second and move on to a question from Eric this time round. What is the position of a director not earning the minimum wage on salary payments when dividends are paid? That's kind of a good question there.
The view of the government low pay unit, which was put out some years ago, is that if directors do not have a service contract, they are not subject to the minimum pay regulations.
Okay. So in other words, it's not an issue if they don't have that contract?
That appears to be the opinion of the government's low pay unit.
Okay. So going back to Kay then, she's provided a little bit more information, so let's follow that one up. We have A and B shares. A shares are ownership and B shares are dividend shares. Does that change anything, or can you add anything to the advice you gave Kay earlier on?
I think for me, and that's one where I'd need to see the original drafting of and the issue of the shares to see what the rights are that are attached to each of the shares, and also to see the history and to understand the employment position as to who actually owns the shares. So I think we're getting quite deep into here something. I'm happy to help if Kay wants to forward documents to me, but I think I need to see a bit more detail to get to a conclusion on that.
Okay, that's fair enough. And just for your benefit, Kay, and for everyone else tuning in, we'll be putting up the email addresses for both Paul and Ernest at the end. So if you do want to ask some supplementary questions afterwards, then they both said they'd be delighted to look at those. Still on the question of shares, but this time round, looking at where people have maybe bought shares in other companies, not shares in their own company. A lot of people over recent years have experienced losses as a result of that. What should they be doing about that as a result of, from a tax perspective?
I think what people need to be doing there, Ian, is yes, it's quite feasible that they'll be sat on some losses that are probably not realised because they haven't yet disposed of the assets. We're talking about shares in this case. Equally, you need to review everything in the round, so they may hold other assets, so perhaps investment properties, maybe commercial property, maybe other tranches of shares where there are some gains sat there, and it's a matter of trying to match the losses by realising the losses in the same years in which you realise the gains in order that you get the benefit of those losses and they don't become unusable. Capital losses, if realised, are quite useful in that you can carry them forward into future years. So with a bit of careful looking at and a bit of careful planning and some input, there really shouldn't be any blot losses, but you need to review all of your assets and all of your potential gains and losses position in the round.
Okay, I've heard that phrase a few times, the benefit of the losses. I always find that a bit of a strange phrase, but I get what you mean with that. What about if we look at another subject area that relates to people who are thinking about closing or selling their business? I've heard of something called Entrepreneurs Relief. Again, it was in kind of briefing notes that you sent through. What's that? How can you take advantage of Entrepreneurs Relief?
I mean, Entrepreneurs Relief is basically it's a statutory claim that someone can make that if they are disposing of either their business assets or shares in what's referred to as their personal trading company, then capital gains up to 10 million on a lifetime basis, they can claim Entrepreneurs Relief and pay capital gains tax at 10% rather than the normal 18 or 28%. So it's a government policy encouraging people to try and make businesses successful, to grow businesses, to grow value, because of that fundamentally is what the economy keeps going on, is individuals having profitable businesses, exporting, employing people here.
Mm-hmm. Right, okay. Moving on from that one, another question, this time from Archie, and this is quite a long question, but I think having read through it, it does make sense, so I'm going to read it out exactly as he's submitted it, because otherwise it's going to lose a bit in the telling. When researching for a private pension, two main options seem to be either payments into a pension scheme that would receive tax relief, but with the eventual pension payments subject to tax, as opposed to payments into an ISA with no tax relief, but capital growth and pension drawdown payments not exposed to tax changes. Is this right, and what's best is the question?
I mean, Archie's summary of an ISA versus a pension is absolutely spot on. I think one has to recognise that there are limits to both ISAs and pensions in terms of the amounts that can go in. So for an individual, they've clearly got to have sufficient income. That's one constraint, that a pension contribution can only be used to reduce income to get the tax relief. So on top of that, there's a finite cap of £50,000 a year gross. Mm-hmm. You compare that with an ISA, where you basically there's no requirement for there to be income in order for someone to invest in an ISA, but there's a much lower limit per year of what can go into an ISA of 11,200 or less if one's talking about a cash ISA. They're simply different.
Right. So it's not a one better than the other, it's down to individual circumstances.
It's down to individual circumstances. Of course, for someone that has a very large income, they'd probably be putting in maximum pension contributions and maximum ISA contributions as well.
Right, so it's not even an either or, it could be
both. Yeah.
It could be both. Okay. Good question here from Catherine. We're operating a limited company and want to build some capital reserves for a future project. Can we somehow incorporate this into our annual return to reduce the tax bill? So it's like putting money aside for a project in the future. How is that going to be treated? What's the best way to deal with that?
I think that's probably more a question about, hopefully I've got my understanding of the question right, but in terms of putting funds aside, the putting aside of funds cannot reduce your tax bill because it's not expenditure or qualifying expenditure. What the limited company structure does do though, so I think if we're in the limited company structure, we're probably in the right structure, because limited companies don't start to pay tax at a rate of higher than 20% until profits exceed £300,000, whereas sole traders and partnerships or partners in partnerships start to pay tax at higher rates once their income from all sources reaches £41,450. So if we're accumulating profits, it makes much more sense to accumulate those in a limited company because they've been taxed at 20, and then making the expenditure out of income taxed at 20 rather than accumulating it as a sole trader or a partnership and making the investment out of income that's been taxed at 42%, 40% income tax and 2% national insurance. So I think the structure's right without having all of the facts, but in terms of a deduction for saving money or putting it aside, that's not possible.
Right.
I mean, I think I would simply qualify Paul's comment there that dependent on the particular circumstances, if what they're actually looking to do is to acquire a building, it may, well, it's theoretically possible to make pension contributions to a pension scheme which might subsequently purchase property up to 50% of the value of the scheme. So depending on exactly what we're looking at, it may be possible to do something by putting money aside into a pension fund now, if it's a pension fund that's controlled, such that the pension fund could acquire the asset later. But that really depends on whether that's the sort of asset that they're looking at. If it's not commercial property, then no.
Right. Maybe I've got the wrong end of the stick here, but I thought kind of occurred to me in relation to a future project that it could be that if you started to, say for example, you were building a new machine and it was going to be a 3-year project, I assume if you started to buy components for that machine in this tax year, didn't actually start to build it until next year, you get deductions for buying those components in advance?
Unfortunately not. Unfortunately not. The basic proposition in order to get capital allowances, which is the relief on the sort of asset that you're talking about, the asset has to be brought into use.
Right.
So simply buying the components and putting them aside, it's highly unlikely that the individual components will have been brought into use for the purposes of the trade or other activity.
Right.
So it won't work in normal circumstances, I'm afraid.
So a room full of components that aren't being used basically aren't tax deductible or capital allowances at that stage?
Unfortunately not.
Okay, fair enough. It was worth a try.
I think that's quite interesting though, and again it's about choices and timing, and how quickly can you get the relief. If it's machinery, we're always going to get the relief at some point in time. And again, of course, it depends on the cash position and the credit worthiness position. There are ways in which, we might want the machine now. We might be with the view that we don't have the cash to buy it yet, but if we buy it on HP, if it is a piece of plant and equipment, we get all of the relief up to £250,000 at the moment at the point at which we buy it, and we haven't spent the cash, and the HP interest is a tax deductible expense. So we might be able to do what we want to do now rather than later. We don't need to delay that, and we get all of the tax relief now, and also the VAT back as well. So again, it's just properly understanding the transaction, and again, just going back to the point at the start, trying to help clients on achieve what they want to achieve when they want to achieve it. Okay.
I'm going to have to almost wind up here. We've got one last question from the audience, and we've just got a couple of minutes before we're due to stop, so it'll have to be quite a brief answer here. But Leslie has gone back to the GAAR rule, and she's basically asking about the main impacts of GAAR on inheritance tax, and indeed where can she get more information on that? Does it have an impact on inheritance tax?
It is stated to apply to inheritance tax. There are some examples in Part D of the revenue guidance on the GAAR, which is on the internet, which touch on that. But they're basically, those examples, they are looking at contrived arrangements where there are trying to remove things that would otherwise be within the inheritance tax regime to just magically move them out, which is completely different to simply having assets which are exempt from the regime itself, which is the normal sort of planning that I think we would encourage people to look at.
Okay. Well, I'm afraid that kind of brings us to the end of our time. We've run out. These things always go very quickly. And I have to thank everybody for their questions. It's been a good mix of questions, and also obviously thank Paul and Ernest for their time today. As I said earlier, we'll be putting both of their email addresses into the chat box on the right hand side. So if you do want to contact either of them directly at A9 Accountancy, then carry on. Feel free to get in touch and ask them some questions. You might also want to visit the A9 Accountancy website and sign up for the newsletter. It's something that when I get I think it's every quarter it comes out, isn't it? Yeah.
That's right, yes.
When I get it, it's one of these things you're never terribly sure, the exact periods, but it's for a year. It's always something I find quite interesting, and I wouldn't class myself as being that interested in tax until it comes to paying the bill, but it's quite an interesting read. So get yourself onto the website, sign up for the newsletter, and of course if you do have any questions for them, the email address should be there by now. So finally, thanks again, Paul and Ernest. It's been really interesting. We probably could have gone on all afternoon, but I'm afraid we've run out of time. So thank you everybody for joining us, and we'll see you again soon, hopefully.